Thank you for the invitation. Thank you for your kind words. Thank you for advertising my books. I was told there are still copies available. If you prefer Chinese, it's also translated into Chinese. Ladies and gentlemen, it is always a special pleasure to visit this wonderful city. Coming here, I could not avoid to remember my late dear friend and colleague in the executive board of the European Central Bank, Eugenio Domingo Solans. Joining his enthusiasm for CF Barcelona has only one limit. This was the case when they played against Bayern Munich. Was it hard to compete with Barca in football, considering your outstanding standard? The challenge in economics is even more demanding. For me, it is an honor and privilege to be invited to the GSE inaugural lecture this year. And it's a special pleasure to see so many young people coming from around the world. I think the profession of economics, of economists, is now so global that this should be a strong contribution to peaceful cooperation in the world. The development of monetary theory and monetary policy over time reflects the interaction between central banks, the political and financial system, and research. I quote from the great work of Knut Wicksell, the Swedish economist: "The choice of measure of value of a monetary system of currency and credit legislation all are in the hands of society. Here, then, the rulers of society have an opportunity of showing their economic wisdom or folly. Monetary history reveals the fact that folly has frequently been paramount, for it describes many fateful mistakes." Quote ended. Times of crisis present a special challenge. The financial crisis starting in 2007 unavoidably triggered memories of the Great Depression and its dire economic, political, and social consequences. From the many studies on that period, the clear message that emerged was: the follies of that time must be avoided, and the world must be safe from a repetition of that disaster. As a result, all major central banks in the world reduced their interest rates to exceptionally low levels. In fact, the expansionary monetary policy was extended beyond the zero bound by also implementing several kinds of so-called unorthodox measures. At the same time, a broad discussion has started on a number of issues. These are: what are the achievements of these policies? What are the risks? How long should the period of extremely expansionary policy last? Should central banks change their strategies? Do we need a new paradigm for the conduct of monetary policy? What should central banks' mandate be? What is the role of central banks in the era of financial stability? Do we need a new institutional arrangement for central banks? What about their independent status? This is a program for a semester, so let me just concentrate on a few issues. First, on achievements and risks. The timely reaction of monetary policy to the crisis in 2008 prevented the collapse and deep problems of financial institutions from plunging the real economy into a situation like that of the 1930s. True, output fell and unemployment increased sharply in many countries. Nowhere, however, did the negative outcome reach the dimension of the Great Depression. In terms of unemployment and recession, unfortunately, some countries of the euro area come close to that experience, but I think for a different reason. Central banks have learned from the past and thus avoided the mistakes, the follies of their predecessors. One could indeed hardly imagine that they would not have learned this lesson. However, While this reaction was extremely important, from a longer-term perspective, it represents the easier part. Approaching the zero bound for interest rate policy, central banks have expanded their balance sheets via measures termed unorthodox because they were not adopted before. While the policies applied had different forms, the overall macroeconomic goal was to stimulate the economy by lowering market interest rates. Whereas the initial programs of quantitative easing presumably had a substantial impact on lowering long-term interest rates, there exists wide disagreement on the durability of this effect and the consequences of the continuation of this policy. Uncertainty about the longer-run effect is, of course, even greater, and thus makes an assessment of the overall benefits and costs of these policies at this stage anything but easy. The fundamental critique of the Fed's unorthodox policy by Alan Meltzer last year stresses the short-term orientation based on shaky data, reliance on the Phillips curve, and disregard for money, credit, and asset prices, that is, conducting a purely discretionary policy. This is also the main point of criticism by John Taylor. Two more aspects are also relevant. One is the potential undermining of fiscal discipline, and the other is the redistributive, or rather discriminatory effects of purchasing specific assets. These are general problems that go along with quantitative easing. Changing the course of monetary policy is always a difficult task. Not too late, not too early, in small steps, or with a decisive move. However, exit from unorthodox measures is a daunting challenge for several reasons. In the context of the zero bound, it is very difficult to calculate the monetary policy stance and the impact of any changes, withdrawing liquidity and or raising interest rates. How will markets react? When the central bank starts selling assets, is this not a signal to private agents to sell their assets outright before asset prices plummet? You have seen what the effect of deliberations of the Fed on tapering had on the markets. Only the deliberations they might taper. If the central bank tries to smooth this process, probably also under pressure from fiscal authorities, will this not be seen as accepting the emergence of inflationary pressures with consequences for inflation expectations, thereby causing even stronger increases in longer-term interest rates? This process is complicated by the fact that a period of extremely low interest rates contributes to higher risk-taking, masks underlying weaknesses in balance sheets, and prevents restructuring of the financial sector. The impact on savings and insurance companies over time might become dramatic. The whole process of allocation of capital is heavily distorted. These undesirable medium-term effects are the unintended consequences of ultra-easy monetary policy. An extended period of very low interest rates makes the financial sector more and more vulnerable to a change of regime. The central bank will have to consider these risks of getting out of the zero bound and unorthodox measures. Extremely low interest rates also have an effect on government. They are hardly conducive to fiscal discipline, and huge stocks of government bonds expose the central bank to economic risks and political pressure. Paradoxical as it seems, the very consequence of large unorthodox measures by central banks could be to contribute to or even create a situation of fiscal dominance, as it was argued by Sargent and Wallace back in 1981. Altogether, monetary policy might be cornered by the financial sector and fiscal authorities. These are strong arguments for being concerned about an extended period of extremely low interest rates. Under these circumstances, when should the central bank consider raising interest rates? The answer depends crucially, of course, on the assessment of the economic situation and implicit risks to price stability. Where economic problems are caused by a collapse of financial markets, the result is much different from a normal cyclical downturn, as Reinhardt and Rockhoff have shown. If economic problems are not of a monetary nature, there is certainly no argument for further quantitative easing. Given the situation as of today, the case for ending the period of zero interest rates becomes more and more relevant. Central banks have reached and reacted to the crisis with manifold ad hoc measures. A vast literature on time inconsistency going back to the seminal work of Kitlan and Prescott in 1977, and credibility as well as experience with policy give a strong warning that pure discretion will lead to uncertainty and volatility. One attempt to overcome this situation and to anchor expectations is by the use of, which is now popular, forward guidance as a policy tool. Ben Bernanke has explained that this is, as he said, not an unconditional promise, but rather a statement about the Fed's collective judgment regarding the path of policy that is likely to prove appropriate given the committee's, the FOMC committee's objectives and its outlook for the economy. On the other hand, the committee, the FOMC, announced its intention to continue buying mortgage-backed securities and other assets until it sees a substantial improvement in the outlook for the labor market, stated that it expects a highly accommodative stance of monetary policy to remain appropriate for a considerable time after the economic recovery strengthens, and has added that it currently expects to hold the federal funds rate at exceptionally low levels at least through mid-2015. The FOMC decision of last week to delay tapering, I think, has highlighted again the problem of this approach. On the one hand, financial markets almost exploded on the news that the Fed continues with a high amount of bond purchases, delaying tapering to a later date. On the other hand, the rise of market prices, equities, etc., increases the risk of a substantial fall once the expansion of liquidity will be reduced or even stopped, not to talk of an increase in the Fed's policy rate. And if you consider on the one hand the intention to guide expectations on monetary policy over years to come, and you consider the explanation by Bernanke given last week to delay the start of tapering was based on changes in a few short-term variables. So I think this is something which makes this approach very questionable. I think the fundamental problem of forward guidance lies in this approach itself. Forward guidance suffers from the same sort of time inconsistency, malaise it intends to remedy. Saying that the policy rate is likely to be low well into the future does not imply that the central bank, from the perspective of a future date and in the face of rising inflation, will have the incentive to follow through on its commitment. The reason being that at this moment in the future, it will be confronted with all the costs associated with keeping its promise, while the benefits will have been reaped in the past. In fact, this forward guidance is very prone to time inconsistency. The credibility of the forward guidance approach suffers severely from the fact that communication of the horizon for forward guidance has changed many, many times. In December 2012 came a move from date-based to outcome-based forward guidance. I quote, "At least as long as the unemployment rate remains above 6.5%, inflation between 1 and 2 years ahead is projected to be no more than a half point above the committee's 2% longer-run goal, and longer-term inflation expectations continue to be well anchored. It is indeed a daunting challenge to make this guidance understood and believed by the public, as the Vice Chairman Janet Yellen has indicated. Assessing the relative impact of asset purchases and the policy stance expressed in the US by the federal funds rate, but this applies to all countries which implement this policy, will be anything but easy for the central bank itself. How can the public understand this? What about changes in the composition of the relevant committees, FOMC, Governing Council of the ECB, etc.? Over such an extended period of time, years to come, it is extremely difficult to forecast the impact of the announced monetary policy on the economy. New shocks might hit the economy. The time dimension of those developments varies with the type and magnitude of shocks, the prevailing financial sentiment, the international environment, and many other variables. Is it therefore not impossible to set the horizon for monetary policy in advance? Credible forward guidance, and thereby the anchoring of public expectations, which is the goal, cannot come from announcing a fixed number for a policy rate, but from providing a strategy which allows the public a kind of ex-ante understanding of policy decisions under varying conditions by the central bank. Announcing a specific number for one policy instrument, the main interest rate, for an extended period of time might be seen as an unconditional commitment which carries the risk that any change will be interpreted as a surprise, with the potential to cause turbulence in markets and hurt the credibility of the central bank. On the other hand, conditionality of such an announcement might in the end give no forward guidance at all. There is even the risk that a kind of implicit pessimism about future growth might have an adverse effect, which was stressed by Mike Woodford, for example. It is not surprising that the end of inflation targeting as the state-of-the-art approach has triggered a discussion about other concepts. Announcing a nominal GDP target path is one of them. This should fulfill two conditions. It must allow for identifying the exit from a policy which keeps the interest rate at the lower bound as long as GDP remains below target. When this level is reached, the central bank will raise the interest rate to the level that is needed to maintain nominal growth around a steady growth path. GDP, or rather GNP targeting, had its heyday in the 1980s, last century. However, this strategy was never adopted in spite of some theoretical appeal. GDP growth cannot be controlled directly. As a result, McCallum proposed adopting the monetary base as a variable that the central bank can accurately set day to day. This advantage of a GDP target over a target for money lies in the implicit reaction to changes in velocity. A strategy which relies on the interest rate as the control variable must be based, of course, on a model forecast. In the case of forward guidance, this has to be achieved over an extended period of time. Is it surprising that central banks resisted adopting a policy procedure that depends so explicitly and openly on fallible forecasts as for GDP? This has hardly changed since then. Data on GDP come with lags and are subject to substantial revisions. It is also hardly convincing that such a strategy could be understood by the public. The message for the public might be that price stability or low and stable inflation for an extended period of time is of secondary importance or is even being sacrificed for stimulating the economy. Such an unanchoring of inflation expectations could have serious consequences. Rising inflation expectations might lead to higher long-term interest rates, thereby producing the opposite effect to that intended. And we know from the past how costly in macro terms it is to bring the inflation rate and corresponding expectations back to a low level and restore the credibility of the central bank. Central bankers now regularly stress the fact that inflation expectations are firmly anchored at low levels. All kinds of measures, be it break-even inflation rates over various time horizons, inflation-linked swap contracts or surveys, seem to support this belief. However, is there not the risk that after such an extended period, low inflation expectations in a backward-looking way are just reflecting the notion that this regime will continue? Consequently, the situation might be rather fragile and exposed to abrupt changes, to shifts, once doubts about the orientation of central banks arise. Concepts like the aforementioned seem to forget how problematic and even dangerous it is to rely on data for potential growth, the output gap, or the NIRO. The severity of this crisis is obviously used as an argument for ignoring such warnings. Yet the misleading character of real-time output data is well known. Athanasios Ophanides and others have explained the policy mistakes of the Fed in the 70s of the last century due to the fact that they have relied on real-time data on the output gap, which were substantially revised later. However, the different nature of this balance sheet recession which we are in might even strengthen such warnings. Reinhardt and Rogoff have argued that it takes much longer than after a normal recession for the economy to recover on a sustainable basis. A policy which ignores this might lead to severe mistakes. Finally, what about the risk of GDP targeting or any other approach of longer-term forward guidance, assuming Robert Gordon's and others' warning that, for example, the US has to expect lower growth for decades, for reasons not related to the financial market crisis? This brings us back to the fundamental question of what monetary policy can do and what it cannot do. In his famous presidential address, Milton Friedman, back in 1968, argued that the central bank can control only nominal but not real variables and should not target the rate of unemployment or employment. Is this conclusion now discarded? There still seems to be a widespread consensus that in the long run there is no trade-off between unemployment and inflation, and that inflation is determined by monetary policy. There are many sources and supporters of this view, and this is not just Bundesbank thinking or Otmar Issing priors. Janet Yellen, for example, has made the same argument recently. However, two consequences then seem rather obvious if Friedman's statement is still correct. First, if the central bank promises more than it can possibly achieve, its reputation over time will suffer severely. Secondly, how convincing is any strategy for monetary policy which does not include an assessment of risk to price stability stemming from monetary developments? The perseverance of ignoring an active role for money and credit in concepts widely seen as state-of-the-art is as striking, for me, as the neglect of studies which demonstrate the importance of monetary developments. Monetary developments are a kind of summary indicator of asset price developments. A thorough analysis of monetary aggregates, considering also, for example, the old concept of inside versus outside money, can deliver valuable information on risk emerging in the banking sector. It is especially Shin, who will now become chief economist of the Bank for International Settlements, who has contributed substantially to this question. Money and credit, more than real variables, contain information for signaling asset price booms, which later might turn out to become very costly. Hence, a central bank which integrates the analysis of monetary developments into its strategy will have a kind of compass for how to deliver its best contribution to preserving financial stability too. In the first place, macroprudential policy should take care of financial stability, and the success of this policy would reduce the pressure on monetary policy. However, an encompassing strategy would protect monetary policy from getting into conflict with its goal to maintain price stability. Recent experience confirms the validity of the ECB's decision on its strategy incorporating developments in money and credit. What should we infer from the fact that the ECB is still, the only major central bank in the world which seems to have a convincing answer to this challenge? This is a strong, albeit not the only argument against international coordination of monetary policy. There is no disagreement that cross-border flows may have an important impact on domestic monetary and credit aggregates, and vice versa. Yet, this makes the task of maintaining price stability and preserving financial stability too, for domestic policy, more complex, but not impossible. The idea that major central banks should internalize the spillover effects of their policies by creating a kind of international monetary policy committee that will report, I quote, regularly to world leaders on the aggregate consequences of individual central banks' policy, a suggestion by a committee comprising very famous international economists. I think this approach lacks any convincing theoretical basis. Agreeing on a possibly wrong model for monetary policy could only end in disaster. However, the negative international spillover effects of independent national discretionary monetary policies could also be severe. Ladies and gentlemen, let me refer to some conclusions. Of course, this issue, consequences for independence of central banks, which was discussed at the last meeting of the American Economic Association, describing the difference between de jure independence, which is in the statute, and de facto independence, which is expressed in the conduct of monetary policy, is a complex and extremely interesting issue, which for time reasons I cannot refer to. So let me come to the conclusion. A broad consensus has emerged that price stability, sometimes defined as low and stable inflation, must be the top priority for monetary policy, that the independence of the central bank was an indispensable prerequisite, and that inflation targeting was the optimal strategy for achieving this goal. There are indications that this consensus does not exist anymore, or is at least being disputed. Greater flexibility and tolerance for inflation, closer coordination with fiscal policy at home and internationally with other central banks, and a broader mandate, including financial stability, are the main arguments for a reorientation of monetary policy. The crisis its causes and its consequences, has demonstrated that inflation targeting as a dominating concept has failed. All attempts of rescue have ended in a more or less, I think, meaningless approach. In light of that, one might ask for a new paradigm for the conduct of monetary policy, but learning the right lesson would bring us, to my mind, rather to a recollection of lost or ignored principles. The new debate on the status of central banks demonstrates that the consequences of rules versus discretion should be reconsidered, and the independence of the central bank should be preserved via a single mandate and corresponding behavior of the central bank. How long, I asked, will we have to wait until the neglect of money and credit in monetary theory and policy will be understood as the major source of macro policy mistakes? Is it not strange, to say the least, that in a world in which money, credit, and financial markets play a fundamental role, models which give these variables hardly any active role are still dominant? And how many speeches and papers by central bankers are presented in which the term money or credit was not even mentioned? This is certainly not true for my speech here. Considering the developments that have taken place over the decades, one should expect that the time of monetary macroeconomics and monetary policy without money and credit will come to an end. Hopefully, this will happen before a new and probably even deeper crisis sets in. Ladies and gentlemen, I thank you for your attention.